everyone's doing well. My name is Clayton. I'm the primary portfolio manager for Centurion Growth, our business consulting and asset management firm. And I own and run the live call every single day for Centurion Education Group. It is a financial literacy group on multiple platforms where we strive to provide as much value as possible to everybody who is willing to better understand the market, their business, credit, multiple different markets, the housing, better keep up to date with the economy, the Fed, politics, everything. We cover it all. And
hi, I'm Joshua Stauffenberg. I'm the Chief Operations Officer of Centurion Education Group, and today we're going to talk a little bit about covered puts and how to move forward with that from a personal perspective.
Excellent. I love this.
So, Clayton, the dying to ask you a little bit similar to our covered calls video, but what is a covered put and how is it different than a covered call?
So covered puts are fascinating. I absolutely love them. It's one of the few things that I can, without buying shares of stock, generate cash flow in a portfolio.
Really?
So with covered calls, I have to buy 100 shares of stock and or multiple increments of 100 shares of stock to generate cash flow and actually be able to utilize a covered call.
Right.
But with covered puts, it's different. So, and I'll give you an example. Let's say I have a stock that costs $20 a share. And I go to the strike price and the options change. Strike price is a theoretical share price. And I want to buy that stock at $20 a share. What I would do is I would sell a put for a 20 strike, which means I have to have $2,000. So 20 times 100, because I would be eventually having to buy 100 shares if I get exercised. I need to have $2,000 cash in my portfolio.
Understood.
But the beauty of that is if I don't want to buy stock right now, and let's say the market's very high, I can sell those covered puts and still generate cash flow without having my money in the market. Now, it's locked up temporarily for the duration that I'm holding that covered put, but it's not in any asset. It's not in an ETF. It's not in 100 shares of a stock. It's in cash. And I sell a covered put and I make my profit and I close that covered put, and that cash is now unlocked for me to use again for the next round of covered puts. So that's the main difference and the primary benefit, because back in January, everybody was euphoric, everybody was happy, the market was super high. I was very heavy cash. You and I talked about this over and over again.
No, absolutely.
I was very heavy cash because of everything that was going on imminently with the economy, and I was selling more covered puts than I possibly could sell because I was so heavy cash and I wanted to generate cash flow and create a bigger cash store for when the market drew down.
Right.
And that has given me such a return now that the market is on a 20+% discount. So that's the main difference between covered calls and covered
absolutely. Now you kind of mentioned this a little bit earlier, but what do you personally specifically look for when it kind of clicks in your brain and you're sitting there at the computer and you're saying, okay, this is going on with the market right now. What do you look for when you're trying to enter into these covered puts?
So that's a phenomenal question. There's two things that I look for. One, where would I like to buy the stock?
Okay.
And two, where I think the stock will not get to in share price or not fall down to where I would get exercised.
Right.
And what that means is if I have a share price of a stock at 20 and I sell a $18 strike covered put, if I sell that covered put, I could want one of two things. One, I could assume the share price is going to go below that strike price. Sure. So 20 down below 18, which would mean I would be forced to buy 100 shares if the covered put were to expire in the money.
Yeah.
So I would buy 100 shares at 18, which would cost me $1,800.
Oh, absolutely.
Here's the other part. If I think that the stock is not going to get to $18 a share, and I think we're at a major support, which is really all I trade off of is resistances and supports. I don't use indicators. I don't use anything fancy. My charts are the most boring thing in the world. There's straight horizontal lines on it, and that's it.
It's true. I've seen them.
I do not overcomplicate my charts whatsoever. I do not have 60 different colors on there. It is just green bars and red bars and horizontal lines showing where we've gotten to and where we've fallen to. That is it. That is it. So If we're at a support and I don't think it's going to fall any further, I will sell covered puts below that because covered puts are a bullish trading strategy.
Sure.
So let's say the share price rises and I get to buy those covered puts back for cheaper, creating my cash flow. So those are the two reasons why I would be deploying covered puts, either to acquire shares or just to create cash flow.
Okay. And so speaking of cash flow, right? How do you personally make that cash flow month over month when you're trying to, trade it? Like when you see those graphs, like that very simple graph setup that you have, right? How would you personally go about doing that?
Okay. So again, covered puts fundamentally are a bullish trading strategy. So I make money on those puts when the underlying stock or ETF goes up, okay, appreciates in value. So what I do is I look on a weekly, bi-weekly, or monthly time frame, and I see how far we've fallen to in that time frame, and I sell my puts below what that weekly or bi-weekly or monthly lows is.
Right.
I try to at least. And if it doesn't get down to that point, then I get to keep the full premium, and the contracts will expire worthless.
Oh, absolutely.
And trading it incrementally, and you've seen me recently because of how volatile we've been, I'm day trading these covered puts and covered calls.
Yeah.
So I could get covered, the stock could fall right at open. I can get my covered puts, and then the rest of the day we can just run, which deteriorates the contract value. Again, covered puts are a bullish position, so they will start to be in profit, and I can buy those puts back for 50% of, or 60 or 70 or 80% of what I was initially credited. So I could get credited $100 when the stock falls in the morning, and then it flies up, and then those puts are now further out of the money, losing value. So let's say those puts are now worth $50. I buy the puts back.
Right. And
I keep the $50.
Exactly. No, absolutely. Now, kind of to move on to another part of this, in your opinion, are there any specific pros and cons to it? Is there any specific risk when you're looking at this that we should really talk about for new people entering this type of strategy?
Absolutely. So the biggest risk that I could take on is if I were to get exercised on a covered put for a share price that I don't want.
Okay.
That's one of the biggest things. So if I am selling covered puts for cash flow and I see that I'm about to get exercised potentially for a share price of a stock that I don't want, and I was intending for me to just receive the premium,
sure,
I can buy that covered put back and roll it down to a lower strike price a couple weeks out.
Okay.
To give myself more room for the stock to fall, or for the stock more time for the stock to ultimately bounce off of where it falls to, go higher, and that put to profit.
Absolutely.
So the biggest thing is understand that if you are going to not roll over a covered put to a further out expiration for hopefully more premium or credit, you better be happy as a clam to buy those shares at that price, because you will get exercised if that put is in the money at expiration. That's one of the biggest risks. But that's why I go pretty far out of the money with my puts. I calculate my risk. I go a little further. I give myself good cushion, and I go a little further past the supports that I'm looking at. I give myself great cushion, and I have a multi-leg process. So again, if the first leg or even the second leg gets exercised, or I have to roll them over, I am going to be at least a minimum break even from the other legs.
Oh, absolutely.
So that I don't take a loss on the rollovers, and I make sure that I get credited on those rollovers.
Absolutely. Now, I did ask you this in our covered call video, which if you have not seen, please go check out. It should be below. But is there anything that a person looks into, right? They now know some form of the strategy of covered puts. Should they just go about and say, oh, I want to put it on every single well-known Fortune 500 company? What would you personally say is just a guideline that you test to? What's the strategy behind it in your mind?
Two factors. First factor is you want to make sure that you're using your dollar to its fullest extent, right? So if I'm going to do covered puts on Apple, I would have to lock up right now. Apple's at $140 something a share. So if I did an $140 strike price covered put, I'd have to lock up $140 a share times 100. I'd have to lock up $14,000 to get pretty terrible premium. Not gonna lie, pretty terrible premium. And let's say I made $100. I would make $100 on a covered put on $14,000 locked up. No shot.
Makes you rethink a little thing.
No shot. But that leads me into the next part,
Sure.
where, and it does, yeah, rethinking it is, you should be doing that. Think through everything that you do. The other part is do I want Apple stock? Me personally, no. It doesn't move. And I'm using an iPhone right now, but Apple's all right. You know, I don't have any Apple products outside of my iPhone. That's because I want to FaceTime my family, all right? Try to be a good guy when I can.
Oh, yeah. Every once in a while.
Hey, that's the way it goes. And the iPhone is simple for the Padre and the Madre, okay? Simple for them to use. So, do I want Apple stock, and is it worth me locking up X amount of dollars to run these covered puts? For Apple, for me, the answer is no across the board. So, I try to find and have found what I want to use to get great premium, great return on my dollar, and if I were to get exercised, I want to own the asset long term. I don't care if it's 6 months, 1 year, 2 years, until I retire. I want to own that asset if I were to get exercised. Now, the question comes in is, do I want to own the asset at the price that I'm selling those covered puts? And that's the trading side of the aisle.
That's a good.
Right? That's the trading side of the aisle. So, if I don't want to own it, I can roll it over. I can buy the puts back. There's a lot of things that I can do to make sure that I don't own it at a price that I'm not comfortable with. So that was a great question.
No, but and if you guys are ever interested in the idea of learning more about covered puts or have any of your own questions that you'd like to ask, we do run our Discord every single day, Monday to Friday. We feel free to ask any single question that you have. We're there to help you. We're there to give you what knowledge we have and help you along in your investment journey, so to speak. The Discord should be plugged in down below. And if you have any questions, please comment, like, subscribe, and should see you soon.
Share it with all your friends who want to pay their bills, which should be everybody.
Yeah.
And if you're somebody who's paying your bills and then some, give us a call. J.G. Wentworth. Get your cash now.
Get your cash now.
You guys take care of yourselves. Have a wonderful day. I hope this provided you value, and I hope that you are able to better understand how to utilize such a beneficial strategy as covered puts and covered calls and the whole wheel. And in the next video, we're going to talk about covered calls to covered puts and truly running the wheel, the infamous wheel. That's going to be the next video. So we'll see you there.
It's a good one.